Are you an investor looking for guidance on when to be an aggressive buyer of stocks or when to be more tempered in your enthusiasm? Well, the buy-hold indicator could help you out. In this video, I'll explain the buy-hold indicator, how it works, and how you can use it to increase the probability to make better financial decisions and not be dumb money. I would really appreciate it if you'd just take a quick moment and like and subscribe. It really helps us out. Thanks. Let's make it clear that the buy-hold indicator is just one tool that we can use out of many. It measures one thing, and while it's a useful thing to know, you should never base an investment decision on one factor or indicator. Now, with that in mind, let's dive into the buy-hold indicator. It's a simple sentiment metric that measures the percentage of the U.S. stock market value that is parked in liquid, taxable money market accounts. Now, this is calculated by dividing the amount sitting inside taxable U.S. money market accounts by the price of the Wilshire 5000 Total Market Index, which you can find quoted daily at several places. Now, we view this number as a percentage number, so the number that's spit out, that's a percentage. The buy-hold indicator is a contrary indicator. The more bullish investors are loading the boat with stocks rather than saving for a rainy day, the less interested we are in investing aggressively, and the more they hide money like burying it in the backyard, the more excited we are to back the truck up with the cash that we have to deploy. With the buy-hold indicator, you can identify opportune times to put more capital into equities when Wall Street is fearful or to save your cash when euphoria runs high. Now, we should aim to benefit from the dumb money, if you will, out there, herd mentality of the institutional investors and their algorithms, who often trade too much, think too short-term, sell when they should buy, and buy when they should hold. Let's try to visualize this by imagining blowing a big bubble with bubble gum. So as you blow, the bubble gets bigger and bigger, but eventually it becomes harder and harder to blow more air into the bubble without it bursting because it's already stretched to its limits. Just like the bubble, the market can also reach a point where there's too much money invested in it, and there's not much room for more investment gains. Because when people buy stocks, the price trends up since buying is the demand side of how any market works. Now, this is when the buy-hold indicator goes down, indicating that there's a high percentage of cash invested in equities and not much left to deploy. Inversely, if some of the cash invested in the stock market gets pulled out because of fear or uncertainty, the buy-hold indicator goes up because when more people are selling stocks, the price trends down since selling makes the supply side of how any market works larger than the demand. This is similar to when some air leaks out of the bubble, creating more room for you to blow in more air and make the bubble even bigger. In the stock market context, a higher buy-hold indicator means that more cash is being held in taxable money market accounts instead of being invested in equities, which indicates investor caution. Now, on the other hand, a lower buy-hold indicates that more cash is being invested in the stock market, which suggests investor confidence. Typically, the buy-hold indicator hovers around 10%, but it can fluctuate based on market conditions and investor sentiment. So how can you put the buy-hold indicator into action? When the indicator is above 11.5%, we look to invest more capital in our equity ideas. Now, this is a buying signal. On the flip side of the coin, when the buy-hold indicator is below 9.5%, we take a more conservative approach to allocating into equities and focus more on building our cash position. This is a hold-off on buying signal. Anything in between 9.5% and 11.5% represents a marginally more or less attractive time to invest. You could do several different things during that marginal time. Like dollar cost average into an index or sector ETF with low fees. You could continue to dollar cost average purchase into an already established portfolio that you have. You could build up more cash or a combination of things in a conservative manner, all while you wait for the times with the highest probability of higher returns. The higher the buy-hold indicator, particularly above 11.5%, the better. Looking at history to put the buy-hold indicator into context, it was below 8% right before the market dropped 22% in a single day in 1987, also known as Black Monday. More modern day, the buy-hold indicator was above 40% during the 2008 financial crisis, indicating investors had more than 40% of the stock market's value tied up in cash. As traders panicked and the market bottomed, patient investors reaped the rewards for more than a decade. With hindsight being 2020, these were one of the best opportunities to invest in a lifetime. Hopefully you understand that the buy-hold indicator is a useful tool to help you allocate your capital and make better financial decisions. Please view this indicator, though, as a simple guide to help you make smarter, more profitable decisions based on probability, especially when the dumb money is not. Remember, this is just one tool in your investing toolbox to make informed decisions.